I want to bring in Larry Shover from the CME. He's the Chief Investment Officer of SFG Alternatives. Larry, I want to get straight into it with you today. Firstly, by talking about the bond market, I want to get your take real quick before we do energies, because I see the reaction throughout the day, which is softening of some early strength in bonds. What do you make of it?
Well, it just continues to be confounding to me. I mean, like yesterday, yield curve, the 530s went to a new cycle low, continues to flatten out. Consider all the macro news that we're surrounded with, all the fear, all the inflationary fears, and yet we've been in a very, very tight range. And it seems like it's one of those things we'll figure out why in hindsight, but I am sure that I'm not sure, but I'm betting that the yield curve will continue to flatten out. So we'll see some pressure on the front end. The 10-year and the 30-year are going to be stagnant for a while.
I mean, Larry, it seems like today's a pretty good example of why that might indeed happen, right? Because what we were talking about this morning was data, mostly in line with expectations. But in the past month, things have slowed down a bit in terms of the rate at which we beat and the degree to which we beat. And then the Fed comes out today and they say, listen, we got to rein in this economy a little bit, or at least we got to start thinking about it.
Yeah, exactly. And they said something that I'm sure we've never heard before, and that is first quarter GDP is transitory. That is a low number. And we've heard that's like a broken record. But the fact is, like, we are plateauing at a very high rate. I mean, I don't think we're downshifting with the growth figures. But I do think we're looking at inflation through the rearview mirror from February 2nd. I mean, China's CPI was in line. Our core was in line. Our headline was soft. So I think we continue to see verification that the inflation is not where we think it should be. And that's why we're seeing so much congestion with the 10-year yield.
All right, Larry, within this, I see a trade this morning that changed on some fronts, which was stocks were deeply lower around these concerns for geopolitics. They're starting to make a comeback. Small caps were actually higher. And with that, we also saw a spike in crude. Now, even as some of the early morning trades reverse, crude is not. Why the resilience in oil, Larry?
Yeah, great question. It seems like that's one of the only beneficiaries of a risk-off environment. I mean, inventories were down yesterday, and not only that, but gasoline and diesel, both inventories rose on that news as well. But yet everything is up. Part of it, I believe, is that the macro environment is still very sturdy. Demand is solid, 4% global GDP or anything near it. And also, I think oil is priced for perfection. And what I mean by that is that there's so much positive skew in that price. If anything should come out wrong, anything like if there's a shale surprise, in other words, I think we could see an enormous retracement in the price.
So Larry, that's interesting, because my reaction is I look at a day like today, and to push back on them a little bit, I mean, I see that, bring up the chart for oil, guys, even though markets have been hit, for the stock markets, have been hit by all this volatility, the risk off type of days, quote unquote, whatever you want to call it, oil seems to find a way to just keep plugging along, Larry.
Yeah, no, it did. But, you know, we came in this morning with oil up like over 1.5% on the headline about Saudi Arabia and the missile and all that stuff. So I think there's just the tension's very, very high, and it seems to be emanating from the oil price. And again, I think the market's a lot more fragile than we give credit to. On the other hand, the demand is also much more sturdier. Is that even a word? It's sturdier than most of us would, admit to believe. I do think that I don't think oil is a particular fade right now, right here. I'm usually wrong about the oil price. It's one of those things where I'm eventually right. But I do think we'll see a lower. No, it's true. You go back in years. I'm eventually right, like a broken clock. But I do think that the skew is to the downside of the oil price between now and the end of the year.
It sounds like maybe, Larry, to give you a little benefit of the doubt here, which is, love a little self-deprecation, by the way, Larry, that maybe there's kind of a battle between the fundamental story, which I can see why. Maybe one would say, as you point out, crude's kind of priced to perfection, versus the technical side, which is you look at the kind of resilience. Price action has been, Liechtenstein would call it, and confirmation and all that. Is there then maybe a technical story that's a bit different that people are hanging on to?
Yeah, I think it's more of the bigger picture, underestimating the demand, and people continue to talk about shale and a big shale surprise, and I'm one of them who says that. I mean, what happens if they come up with 1.2 million barrels per day, more than expected? That could very well happen. But even with the amount that they're producing right now, we're not seeing it in the inventory. So where is it going? That's the big question. I think that's what's driving oil's price right now. And it's been painful for me because I'm like catching a falling knife trying to be short it, and it's not working out very well.
All right, Larry, careful with those knives over there. Wear some gloves, Larry. Great to get your take this afternoon. We'll leave it there, talking crude. Appreciate it. Larry Shover, he's the Chief Investment Officer of SFG Alternatives.